Hey gang, it's December 5th, it's a Thursday, and I wanted to give you an idea before the market closes just to show you how fragmented this market is. And usually when markets are fragmented, they stay choppy. Now, last 2 weeks, markets were fragmented and we were still going up on the S&P 500, but I was warning you that things are only getting worse. That rubber band is getting stretched out, stretched out, stretched out. Here's the difference. When you have a market that's balanced and it goes higher and higher, it doesn't undo everything over time. In other words, that rubber band doesn't get stretched out. It gets stretched out very, very slowly, and then it contracts very slowly. But in this case, imagine a rubber band that's just totally stretched out all the way, and it needed to snap. And that's what happened the last 3 days of the week. And finally, we're starting to see some balance, but we're far from being completely integrated. The market is still fragmented. For example, New York Stock Exchange up 91 points today. Dow Jones up 48 points. So you're seeing the markets all over the place. For example, if you look at StockFetcher, if you look at I want to show you this. These are my top 10 sectors. This is the entire S&P 500 separated into various sectors. For example, energy, real estate. And each one of these has anywhere from 30 to 60 stocks, and when you add them all together, you get the S&P 500 stocks. So, for example, technology still leads, okay? The problem with that is technology is the most speculative sector, followed by consumer discretionary, but consumer discretionary is in 8th place. And utilities and consumer staples are defensive sectors. So whenever you have consumer discretionary at the bottom, usually utilities and consumer staples leads, but they're nowhere to be found on top. They're actually in the middle. So everything is completely fragmented. I mean, the market is just more and more fragmented, and it's more, every time the stretched out rubber band contracts, it gets stretched out again. In other words, it hasn't had the opportunity to fully snap back. It hasn't had that yet. It hasn't happened. This 4-day pullback hasn't done that. So I'm anticipating over the next, and look at the NASDAQ, just more volatility and more choppiness. So here's what I'm thinking. The first phase 1 of the trade war agreement is supposed to be completed, signed, finished on the 15th. That means we're going to be in a hurry up and wait mode till then. It means choppiness, especially with the fragmented market like we're having right now. So I'm expecting the Dow Jones to kind of hover between the 50-day moving average and say 281 or 28,100. The NASDAQ will probably trade between, this is the NASDAQ 100, 206 and 196. And the S&P 500, let me give you a little trading range there. This is just for the next week or so till we get a little further along, closer to the 15th. And the S&P 500 more likely will move between the 315 level and the 307 level. What I'm seeing right now, usually trading action leading up to a major event will consist of congestion. So we can expect most likely a flag pattern or a symmetrical triangle or a bearish wedge. That's what I'm seeing. Not seeing much directional bias. I was actually very surprised that we were seeing such directional bias, and one of the reasons we saw this directional bias for the last 2 months is because volume was really, really low and institutions were staying out of the mix. Now institutions are coming back a little bit, but not too much, just a little bit, but they're still holding about 70 to 80% of their investments on the sidelines, waiting for China and US to resolve their differences. Till we resolve their differences, you're going to see fragmentation. You're going to see a market action like this. What this should look like is technology, consumer discretionary, healthcare, and then followed by material industries, and then utilities and consumer staples. And we're just totally all over the place. It's like the market is just moving like this. And till the 15th or about the 12th, unless we break off negotiations, which is possible since Trump said we may not resolve our differences till next year, till after the elections, I mean, there's a good chance for the next week or two we're going to see lack of directional bias. Market is coming off overbought territory. Volatility increased. There's no earnings on the table right now, so there's a good chance the market is going to become or stay fragmented. Also, put the call ratio neutral right now. So there's not a lot of bias between the bulls and the bear, and that usually leads to a lack of directional bias and persistent congestion, which dominates the market about 70-80% of the time, and is quite typical after you've seen such a nice trending move over the past 2 months. Remember, the longer you see a trend, the higher the odds the market will switch phases and go into a congestion phase. So what should you be looking at right now? Stocks or assets that don't trade in line with the overall market. For example, TLT, the bond market. If the stock market continues moving down, or if we don't resolve the trade differences and enter phase 1 agreement by the 15th, we're going to see a rally in bonds. You're going to see a rally in the gold market. So you want to stay in assets. As a matter of fact, gold is up today. You want to stay in assets that have either no correlation to the broad market or have negative correlation to the broad market. Gold, currencies, interest rates, volatility. Volatility is a great one too. Anything that has inverse or lack of exposure to the U.S. stock market is where you want to be the next few weeks. Don't expect a major rally. Don't expect a huge move. This is the time to get out of stocks or diversify your portfolio with assets that have nothing to do with the S&P 500. Hope that helps. And things should resolve themselves. We should at least know whether things will resolve themselves or not, and that'll give the market a better way to, or more directional bias, but that's not going to happen until we get closer to the 15th. And today's only the 5th, so we got 10 days to go, realistically maybe another 5 trading sessions. This is a good time to be defensive, sell spreads, iron condors, bear call spreads, bull put spreads, or trade defensive assets that have no correlation to the stock market. That'll put you in a position where you can have your cake and eat it too, because if the stock market congests, traders will be taking their money out of the stock market and putting it into assets that have no correlation or negative correlation to the stock market. Gold, ticker symbol GLD, bonds, ticker symbol TLT, currencies, currencies. Anyhow, I think I've said enough. Stay defensive for the next 2 weeks. This is the time you don't want to be a cowboy. This is the time to kind of sit on the sidelines or position yourself in assets to diversify yourself away from the stock market. Hope that helps. Folks, once again, the market is headed lower and gold is rising. And I expect a choppy market for the rest of the year and possibly even some downside. If you haven't yet, now is the time to protect your portfolio by adding a hedge and securities that rise in uncertain markets. Think of it as an insurance policy. You buy it now before things get ugly. That's why I created a strategy that's designed to specifically generate consistent gains regardless of what the market's doing. The trades may seem exotic, but I promise it's not complicated, and you can use the exact same brokerage you use now for your everyday stock trades. Click the button below, check it out, do it now.